February 20th, 2026. The U.S. economy is still moving forward, but the pace has clearly changed. Growth continues, jobs still exist, markets still trade, yet confidence is no longer expanding, it is stabilizing, and in some areas, it is thinning. Inflation has cooled from earlier peaks, but prices have not come down. For most Americans, daily expenses remain elevated. Rent stays high, insurance costs rise, healthcare remains expensive, food prices feel permanently reset. This creates a quiet pressure, not panic, pressure. Wages have grown in certain sectors, but wage growth is no longer accelerating. Purchasing power feels limited. Households are adjusting behavior. Not dramatically, gradually. Spending is more selective, subscriptions are trimmed, non-essential purchases are delayed, travel continues, but with tighter budgets. This behavior matters because consumption drives the U.S. economy. When spending slows quietly, GDP reacts slowly. Consumer debt continues to increase, credit card balances remain elevated. Interest rates on revolving credit stay historically high. Minimum payments rise month after month. This reduces flexibility. Households can still spend, but they have less room to absorb shocks. Auto loan stress is becoming more visible. Delinquencies rise at the margins, not across the system, but enough to be noticed. Student loan payments continue affecting younger households. Major life decisions are delayed: home ownership, family planning, long-term commitments. The housing market remains constrained. Mortgage rates are still elevated. Existing homeowners stay locked into low-rate loans. Supply remains tight. Prices remain high. Affordability remains low. This limits mobility, and mobility matters for economic dynamism. The labor market remains stable, but momentum has slowed. Hiring is selective. Job openings decline from earlier highs. Temporary work is softer. Overtime hours flatten. Layoffs remain targeted, not widespread, but noticeable. Technology, media, finance. Efficiency is the focus, not expansion. Artificial intelligence continues reshaping work. Productivity improves, but transitions create uncertainty, not joblessness, uncertainty. Financial markets remain elevated, driven by concentration, large technology firms, AI investment, capital flows. But market strength does not reflect all households. Stock ownership is uneven. Market gains do not translate to broad comfort. Government spending continues supporting activity, infrastructure, defense, industrial policy. These contribute to GDP stability, but federal debt continues rising. Interest payments consume a growing share of revenue. This limits future flexibility. The U.S. Federal Reserve maintains a cautious stance. Rates remain restrictive. Inflation is lower, but risks remain. Policy must balance too tight and too loose. Markets anticipate future rate cuts, but timing remains uncertain. Global factors add complexity. Energy prices fluctuate. Geopolitical risks persist. Trade patterns adjust. Supply chains continue shifting. The U.S. dollar remains strong. This attracts capital, but pressures exports. Manufacturing growth remains mixed. Some regions expand, others slow. Small businesses feel higher borrowing costs. Credit conditions remain tight in certain sectors. Commercial real estate continues adjusting. Office vacancies remain elevated. Refinancing risk approaches in stages. Banks monitor exposure carefully. None of these signals suggest immediate recession, but together, they describe an economy operating with less margin, less flexibility, less tolerance for shock. This is not collapse, it is late-cycle behavior. Growth slows, debt remains high, rates stay restrictive, confidence becomes fragile. The danger is not fear. The danger is assuming stability equals strength. GDP measures activity. It does not measure comfort. Employment measures jobs. It does not measure security. Markets measure liquidity. They do not measure resilience. The U.S. economy in February 2026 is functioning, but it is sensitive. Small changes can have outsized effects. This is the phase where policy decisions matter most, where consumer behavior matters most, where confidence matters most. The next shifts will not be loud. They will be gradual, quiet, and visible only after they are established. The economy is not warning loudly, it is signaling softly, and soft signals are easy to ignore until they are not. If you want to understand the real economy, look beyond single data points. Watch behavior, watch confidence, watch margins. Because real economic change rarely announces itself. It arrives slowly, then suddenly feels obvious. This is not fear. This is awareness, and awareness is how stability is protected.